Well, good morning and welcome everyone to another edition of Real Estate Investor Storytime. It is 9 a.m. I am James Orr, and today we're going to go and talk about Peter. Peter is a new real estate investor who happens to be from Denver, about an hour, maybe a little bit more south of me. I live up north in Colorado. And Peter is considering getting started investing in real estate. And one of the things we're going to learn about Peter is he's trying to figure out whether or not he should put 20% down, 25% down, or maybe even try this crazy thing called Nomad, where you could put 5% down and acquire properties. And there's more to this question than there appears at first glance. You might think to yourself, 20%, 25%, really the only difference is how long it takes you to save up the down payment. And the fact that you're putting a little bit more down, you end up getting, a little bit better cash flow because you're borrowing less. Not so fast. It's kind of a little bit more detailed than that. Speed has a major factor in how Peter's going to do. How quickly he can acquire properties, because the quicker he can acquire properties, the quicker his personal net worth is growing at these higher rates when he acquires the rental properties. So speed is going to be a major factor. And here's a curveball for you. When he puts more down, something else changes beside just how much he put down. Anyone guess? That's right. It's the interest rates. Interest rates change too. So it's a compounding effect as to what happens here. So what we're going to do is we're going to learn a little bit about Peter and his situation and go through the story of 20% down. We'll look at 25% down. We'll look at 5% down, kind of do a three kind of comparison version of the story today, which first time we've done that. We'll see how it goes. And I think what's going to happen with Peter is we will use Peter as sort of like a baseline to start adding in complexity. So today we're just going to go over kind of three different loans and how fast that impacts things and things of that nature. But eventually we're going to add in things like, what happens if interest rates are going up while Peter is acquiring his properties, which with interest rates at all-time lows right now, you would think, hey, maybe there's a chance that interest rates are going to go up between now and when he buys his full 10 portfolio properties. I don't know, maybe just a chance that they're going to go up. And maybe rents aren't going up at 2% a year, which is what I've assumed for Peter, which is below what we've seen in Denver. So maybe they don't do that. Maybe they go up, maybe they go down, maybe they go up, they go down, they go up, they go down. I don't know. We'll see. What happens if property values don't go up? What happens if they don't keep pace with inflation? Inflation, I assumed here, is 2%. But we're going to see a whole bunch of different things with Peter. And we're going to see things like, should he aggressively pay down properties? Should he take all of his extra money and pay down loans? Should he do cash out refinances in order to acquire properties faster? So we'll do a whole bunch of stuff. And we're going to look at risk. Is it maybe better for Peter to do it one way, but more risky? And maybe he succeeds most of the time if he does it one way, and maybe he actually goes broke and bankrupt and has foreclosures in another case, which is less than ideal. That's my gentle way of saying you probably shouldn't do that. But we shall see. But that's all in the future. Today, we're going to talk about Petey Boy and 20% down, 25% down, 5% down Nomad. Okay, so let's go over some of the assumptions we use for Peter. I'm going to start off with the 20% down because I think that's the first plan that appears to most people, right? The idea that, I want to buy investment property. I don't want to have to do this crazy moving into properties and Nomad and stuff like that. I want to actually buy the rentals, not have to move in. And so I heard somewhere that I need to save up 20% down payment. And so that's what he's considering first. Turns out, for those of you that have come to my financing class, you know that you can technically buy rental properties, non-owner occupant properties, with as little as 15% down. In fact, if you're willing to do creative financing, you can do less than that. But if you want to go get a new loan and do conventional financing, you can do a 15% down loan. It's just usually not pretty. So he's going to do 20% in this case. And then we're going to look at 25%. We'll look at some other stuff. So this is the 20% situation. I think Peter makes $6,000 a month, about $72,000 a year. He lives in Denver area. So his effective income tax rate, all I did is I went to the website there shown, and I put in his income and where he lives, and it kind of gives me his effective income tax rate. So 24.02%. That's what his effective income tax rate is. I assume the inflation rate is 2%. Historically, inflation has been closer to 3%. And I do a whole class on inflation and the impact of inflation on financial independence portfolios. But in this case, I use 2%. Why did I use 2%? Because the Federal Reserve has stated that their target inflation rate is 2%. So the government is doing everything in its power to maintain a 2% inflation rate. So I said, hey, let's use what the government thinks they're trying to achieve, even though, I don't know, maybe they're a little higher, maybe they're a little lower, maybe they're a lot higher. With as much money as they're dumping into the economy or about to dump into the economy, maybe it's maybe we see a higher inflation rate. I don't know. We could change that. We can make it variable. Mortgage interest rates, you can ignore this one for now because I'm going to show you the actual interest rate he's getting on his properties. It actually is different depending on which loan he takes, which down payment. So you can ignore that for a second. And his target monthly income in retirement. So this is how much money he's trying to generate passively from his rental properties and any investments he has in the stock market or anything else. He's trying to replace $5,000 a month. But wait, James, I thought you just told me that Peter makes $6,000 a month. Why is he only trying to replace $5,000 a month in income passively? Oh, that's a really good question. It's because his standard of living, the amount of money that he's actually living off of is $5,000 a month. He's saving $1,000 a month from his paycheck. So really, even though he's earning $6,000 minus taxes and all that other stuff, he's actually living on as if he made $5,000 and he's putting away $1,000 a month. So really, when he gets to the functional retirement, his point where he's able to live on his investments is not when he earns the $6,000, because if he got to that point, then he'd be saving $1,000 of that still. It's really when he gets to that $5,000 a month. And so $5,000 a month is his target monthly income in retirement. And his yearly safe withdrawal rate, I know I've done some classes on safe withdrawal rate before, so I won't go into crazy detail, but we've assumed it is 4%. So he's able to take 4% of any money he has in stocks and bonds and all that other stuff, and withdraw 4% per year, and that's what he considers safe. And so we will use that as part of our calculation to determine when he has hit his functional retirement, when he is able to live off of his investment passively. Now, this has the yearly safe withdrawal rate, for those that don't know, has absolutely zero to do with his real estate. So the real estate stuff, we're looking at the actual cash flow after all expenses, property management, taxes, insurance, mortgage payment, all that other stuff, vacancy. And that is going to be determined how much money is coming from his real estate that counts towards retirement. There's no 4% rule, 4% safe withdrawal rate rule that we apply to the real estate. In fact, I probably should do a class on that. What is the equivalent of a safe withdrawal rate for real estate? I'm going to make a note. Note to self. You get to witness how I work. You get to witness James making notes to himself. Safe withdrawal rates for real estate. New class idea. There you go. That's how I work. And by the way, I know I didn't mention this, but for those of you that are on live, not listening to the recording, you can go ahead and put any questions you have in the chat window. I will answer those, and I will go there. Yeah, Christine says cash flow from rental. Yep, cash flow from rental. Yeah, so I assume you mean that's sort of like the equivalent of the safe withdrawal rate. Yep. There's a little bit more to it, but yeah, you're pretty much right on. That's the 95% answer. All right, so continuing on here. So we're not doing any Monte Carlo stuff. You guys will be able to access the blueprint. Any Plus members or premium members can access blueprints. So you'll be able to really dive in and see all the detail here. We've assumed that Petey Boy, Peter from Denver, has started with $25,000 in savings. We've also assumed, for the sake of simplification, the software can model really complicated stuff, but in order to make this class, only whatever it is, 30 minutes, an hour, however long I end up going, in order to make it a reasonable time, I've assumed that he is earning 8% on his $25,000. And so it is sort of like a quasi catch-all retirement account, maybe invested in the stock market. Sort of like It's a hybrid. It looks a lot like a lot of different things all at the same time. And so he's starting with $25,000. He's earning 8% per year, which in the future, when we do additional versions of Peter's stuff, we will make this variable, because there are years when the stock market doesn't do 8%, where it does way negative, where it does a lot better than 8%. And so we can go ahead and make this random and have his returns be random. And that could impact when he's able to save up and buy a next house, or when he's able to achieve financial independence from the 4% safe withdrawal rate and stuff like that. Hunter says, remind me what Monte Carlo is. Monte Carlo is where you run the same scenario multiple times, usually when it's random. So like if you have a random stock market rate of return, or random rent rate of return, or random price appreciation, or random inflation rate, but you run it a whole bunch of times, 100 times, 1,000 times, 10,000 times, and you can see the range of results you get. So imagine, we set the rent appreciation to be random. Some years it goes up, some years it goes down, some years it stays the same. If you run that scenario one time, you'll get one result. It'll look like, oh, he's able to retire in 25 years. But if you do it again, because maybe rents went up a little faster, or maybe rents went down, it actually may be more or less than that 25 years. And so Monte Carlo allows us to run 100 versions of this, or 1,000 versions of this, or 10,000 versions of this, and actually see he's able to retire anywhere from as early as 11 years to he never gets to retire. It takes him, 140 years to retire. And it will show you the range of values for that and how frequently they occur. So we could say 50% of the time, he's able to retire between 25 and 30. So that's what Monte Carlo is. And it is way, 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 way beyond the scope of what we're doing today. But the software can do that. So we're able to go ahead and run a whole bunch of what if scenarios, like what if the market goes against me? What if we see a market correction in the stock market and or real estate market and or bond market, or whatever? What happens if I lose my job? What happens if the change the loan programs? What happens if interest rates change? And so you can see the result of all that stuff, all combined, or individually. We can kind of see sensitivity. Again, that was way off on a tangent. In fact, I'm gonna take a drink to kind of cleanse my palate from that tangent. Okay, so he's starting off with $25,000 and he's earning 8%. And that's going to be the same for all three different case studies we're doing. The story for Peter, we're going to look at three different kind of situations for that. All right, so now let's start with this 20% down property. I'm going to go over just some basic assumptions. And, if your market is different than this, if you happen to be in a market and you're like, James, you're crazy. No, we're not buying $400,000 properties. We're buying, $60,000 properties, or $400,000. I wish I could buy a $400,000 property. It's $800,000 where I am. No worries. You just come in here and you can change any of the assumptions and rerun it and see how it impacts you. All right. So Peter happens to live in Denver, and property values in Denver, he's going to buy a $400,000 rental, and he's actually going to pay full freight for it. He's going to buy it for full price, no discount. Because Denver market's hot, and he'd be lucky if he can get it for a list price in many cases. All right. So when I made this stuff over the weekend, Saturday, I think, I went and I looked up interest rates, and I found out that a 20% down non-owner occupant investor loan was 3.625%. Yes, that is an investor interest rate. It's crazy low, right? So 3.625 was the mortgage interest rate, and you're going to want to remember that. So if you happen to be sitting at your desk, you may want to write that one down. Although I'll try to remember and tell you. But 3.625 for 20%, because it's going to change for 25% and also for 5% down. He's going to do a 30-year loan, and he's going to put 20% down. We talked about that. So his loan amount's going to be about $320. His monthly mortgage payment, principal and interest, that interest rate, 30 years for that amount of money, is going to be $1,459.36 per month. He's not got any PMI, because you don't have PMI when you put 20% down. Closing costs, we're assuming 2%, a little bit to pay in points in order to get that interest rate, and a little bit of actual closing costs, title work, things of that nature. So his closing costs were estimated at 2%. We're assuming he's buying pretty houses that are ready to go. They don't need any work, so there's no rent-ready costs. He's not getting any seller concessions from the seller. Seller's not going to contribute to his closing costs. It's a really tight, aggressive real estate market down there. So it's not like a market where the buyer is in control and the buyer can set the terms of the deal, and the buyer can say, hey, Mr. Seller, I want to buy your property. You're going to help me buy your property by giving me some closing costs. In this particular case, he's not able to negotiate that. And so we're assuming zero seller concessions. It's a seller's market, not a buyer's market. When we do our depreciation calculation, we're going to assume that 15% is the value of the land. He's going to get his money from that all-in-one account that's got $25K to start with, and he's saving $1,000 a month. So that $1,000 a month is going into that account. When he finally has enough in there in order to buy the properties, plus a little bit in reserves, which I'll talk about in a minute, he's going to be able to acquire one. Then he's going to keep saving for more until he gets enough to buy another one, and he's going to buy that one and keep repeating until he has a bunch of properties. I'll show you all that. We're assuming property values are going up at 2% per year. Now, anyone from Denver, if there's anyone from Denver here, go ahead and do a shout out in chat, because I want to ask you a crazy question. For those of you that are not in Denver and you hear 2%, you may be like, yeah, that seems reasonable. 2% seems like a reasonable thing for my market. Yeah, so Christine says she's in Denver. So Christine, do you think your property values have been going up more than 2% in Denver the last few years? Yeah, exactly. She says yes. So 2% is like ridiculously conservatively low, historically. Now, who knows what's going to happen in the future, right? We could be in a period of time where we've seen this big run up, and now it's like it's got to catch its breath and sort of like taper off and level out. And maybe we only see 1%, 2%, 3% a year, whatever it is. Yeah, she says 14%, 18 months. I don't know if I've seen quite those numbers, and I'm a stats guy and I've looked at Denver, but maybe you're right. Could be. I don't know. It doesn't seem that high to me, but yeah, it could be really, really crazy high. So to use this 2%, it's interesting because it both hurts and helps Peter in his situation. And let me explain what I mean by that, because, and I probably should do some more stories about this because it's a super interesting point. So here's the problem. We assume property values are going up 2% a year for Peter. If Peter owned all 10 of his properties, that's a nice, slow, steady appreciation rate, and he's not earning a lot. But if he owns all 10 of his properties, and now appreciation rates are 6, 7, 8, 9, 10, 14%, 18 months, whatever it's been, according to Christine there, if it's going up like that and he's already got his stuff, he's like, yes, I love this because I own 10 properties and my property values have gone up a ridiculous amount in this really short period of time. I am equity rich. I just had this huge windfall fall on my lap because I happen to own properties during this period of high appreciation, right? That's what you're thinking. But what else happens? Let's say he hasn't quite acquired all of his property yet. Let's say he's on property, he already bought one, and he's trying to buy property two. Well, if property one went up 14%, 18 months, which that seems high, but let's say this, then he did really, really well on that one property, but now he has to reach higher in order to buy the next property. He needs to save up more down payment, and it's more expensive. It's more out of reach. So not only is that second one more expensive, but the third and the fourth and the fifth and the 10th and whatever it is. So it gets progressively harder of this higher appreciation rate. And honestly, for future stories with Peter, we probably should run some situations where the appreciation rate is higher. And you may think at first blush, it's like, James, you're being overly optimistic for Peter. Of course, he's going to have a net worth of $1 gazillion if property values are going up 10%. But it affects more than just like the properties he owns. It affects his ability to buy the next properties, his ability to save up and get the next properties. It's like the train's leaving the station and he's trying to get on board and it's leaving without him and he's having a hard time staying pace with it. Okay. So it impacts more than just what he owns. It impacts his ability to buy ones in the future. And so we should, if we were prudent investors, modeling what could possibly be, if we're planning on a retirement, and the difference between planning correctly is the difference between cat food in retirement or caviar, we should actually look at different appreciation rates, different rent appreciation rates, different inflation rates, different interest rates. We should look at all these things so that we don't start implementing a plan that's not going to work 80% of the time. Okay, does that make sense, everybody? All right, so I went off my rant on appreciation rate for this morning, but we've used 2%. I basically use the same appreciation rate as the inflation rate. So inflation is the tendency for things to get more expensive over time, right? That's the layman's definition of it. You go to the movie theater and it doesn't cost you 50 cents anymore like it cost your grandparents. It now costs you $37 to get a movie ticket, Coke, and the popcorn. Okay, so it's a little bit more expensive. That's inflation. And historically, according to Case Shiller, there are two economists. I think they're from Stanford. Anyone know? Anyone know where Case Shiller are from? I think they're Stanford economists. But they basically did a whole bunch of studies, and they showed that over a very long period of time, I think it was over 100 years, the inflation rate, the appreciation rate of real estate over a very long period of time was about what inflation was. It was about 3%, and the other one was 3.1, and vice versa. I don't remember which one was which, but one of them was 3%, the other one was like 3.1 in the study I saw. Okay, so I used 2%. He's able to get $2,200 a month in rent on this $400,000 property. And I think that's pretty reasonable for the right property. This is not like, all the properties are like this. This is not like median and median. This is like you picked out a decent one. Okay. Rent appreciation, same idea, except how quickly is rent going up in value. And that's also 2%. So we're using 2% for property values, 2% for rents. I've seen some charts in the past that suggest that rents and property values are slightly correlated. They're not exactly one-to-one. There are definitely periods of time when rents go up faster than property values, and there are definitely times when property values go up faster than rents, at least in our markets. It could be different in yours. You could see negative property values and positive rents. I mean, there's definitely markets like that. But again, Pete is from Denver. This is what I'm going to go off on a tangent. This is what I love about these story times, right? Because instead of having to teach generically, I can teach for a specific person, right? I can put Peter in my mind. I could say, this is Peter's situation. Your reality may be different, but this is the reality that Peter lives in. So I love that. I think it's great. No other monthly income on the property. It's not like he's renting a garage or house hacking or doing anything like that. Although we should do one where he house hacks. We didn't today. Vacancy rate, I use 3%. That's assuming he's starting like 90 days early in order to find his next tenant. He's asking his tenants in his property, are you planning on renewing? If so, sign here. Rent's gone up by this amount. Otherwise, I'm going to start advertising the property over the next 90 days, and we're going to find a tenant so that there's like zero vacancy between when you move out and when the new tenant moves in. So that's why we're using 3%, because I think that's a reasonable number for that. COVID could change all that, though. Property taxes, 0.7%. So we're estimating about $2,800 a year for this property. Insurance, 0.4%, or about $1,600 a year. Now, he happens to buy in a place that doesn't have an HOA. It's getting harder to do that. Almost all the newer properties are in HOAs these days. So HOA appreciation rate, we're assuming that those are going up by 3%, but it's zero. So 3% of zero is still zero. Monthly utilities, we're assuming the tenant is paying for all those. And the other expenses, that's all done. Maintenance on the property, we're assuming he's setting aside 10% of his gross monthly rents, or about $213 a month for maintenance on the property. And we are assuming he's willing to put in the effort and manage the properties himself. Based on all of that, his cash flow on his property is about $94.57 per month. $94.57. All right, so here's some interesting things. If you guys have been to my class was it really just last week? That's crazy to think about. Like, time is all over the place. So last week I unleashed the return on investment quadrant plus reserves, and I showed you a whole class, 2-hour class on why everything you've learned about deal analysis has been wrong up till that class. And I made a very compelling case, and everyone loved it. So go watch that class. It's on the podcast. It's on the website, and you can go access that. But you'll notice all that stuff is down here. All the new reserve stuff is right down here. This +6, +12, all of those are right here for you to see. So, but let's do the old way first so you can kind of see it. So in this particular case, he's buying a property. It's been going up 2% on a $400,000 property. So we have assumed, this is like a looking forward statement, we've assumed the property values have gone up $8,000 in the first year. So that's what his return was from appreciation. He's making a little bit less than $100 a month in cash flow. So his total cash flow for the year is $1,135. The amount of loan that he's paid down in that first year is $6,012. That's just looking at how much of the principal is paid down. So $6,000 is the amount of debt paid down. And the amount he got in tax benefits from depreciation So you take the depreciation of the property, and I've covered this in other class, so I'm not going to cover it again today, but you take the depreciation of the property, you multiply it by his tax rate, and this is how much extra cash flow he's getting back on his tax return from depreciation. So 1855. You add all of those up, and he made about $17,001 per year in the first year for this particular property. So that's the return in dollars. If you take that return from each of the quadrants or the total, and you divide by the total amount he needed in order to buy the property, which is down payment and closing costs in this example, then he had 9.09% from appreciation because it's leveraged. It's only going up 2%, but he was 5-to-1 leverage, so that's what it was. And then cash flow, 1.29%. So his cash on cash return, for those of you that are used to hearing about cash on cash, it sucks. I mean, it's the reality of Denver, but it's not very good. It's 1.29% is what his cash on cash return was for the year, doing the calculations correctly. His tax benefit, the return from the tax benefits, 2.11. His overall debt paydown return, 6.83. And so his overall return on investment for buying this property with 20% down in year one was 19.32%. Okay, so a little less than 20% return on his money buying this property there from all four of those areas. You can see what the total is for each of those four. So here's the return on equity, which I'm going to skip because we're not going to do that. The return on investment quadrant plus reserves. So if we're going to start doing this correctly, I should probably start showing it to you. So I added in his return from his reserves, or $122 there. You can see those dollar amounts didn't change, but the return on investment, when you do the calculation there, those numbers change. So when we calculate in the drag on his returns, including reserves, but we also add in the return he's getting from investing his reserves, he gets a total of 17.08% return for keeping 6 months of reserves in a savings account. So 17.08 versus 19.32. So it's a little bit less when we take into account the reserves. And this is what I taught that whole class on. So go watch that class if you want like a lot more detail, 2 hours of detail on just that point alone. And then if we do 12 months of reserves in the stock market, which is more what he's doing here at 8%, his return is 16.86. So this is a better reflection of reality of what his real return is doing these properties, including the impact of reserves. Okay, so with that being said, let's get back to stereo. So we had that property there. So paychecks, he's going to make $6,000 a month. We're going to stop him working whenever he achieves financial independence. So when he gets to the point where his rents, after all of expenses coming in, equals enough for him to live on, well, his rents plus any money he has invested in the stock market at a 4% safe withdrawal rate, those combined equal at least $5,000 a month, adjusted for inflation. That gets adjusted. But when that actually equals enough where he can live on it, then he stops his working at his job. Okay, so that's what it is for there. And then his personal expenses, he's living on that $5,000 a month. So his $5,000 a month includes all his living expenses, all of the taxes he's paying on stuff. That's everything included in there. Okay, and in some cases, he is, for the ones where he's buying 20% and 25% down, he is renting himself. So he's living in a rental, but he's buying rental properties and doing that. In the one where we Nomad, by definition, he's moving into the houses and living there. So in those cases, he's going to have a little bit less, $2,200 a month less in living expenses, and he's going to have the expenses of the property that he's supporting. So that's why there's an adjustment here for that. And then he's using this rule of buying properties. He's going to buy 10, 20% down properties, and he has to have the total amount he needs to close plus, for this rule, we're saying he needs at least $5,000 in reserves, inflation adjusted. And he's going to stop after he buys 10. And CC says, with the reserves, are we also taking into account that it takes him a bit longer to buy each subsequent house? And the answer is, in this case, no. In a new update for the software, because I just did the ROIQ plus R thing, I will have you be able to put in, you need to save X months of reserves, and it will actually do those calculations correctly. Right now, the only way it does it is you set the dollar amount of reserves, and it does do an inflation adjustment so that they get more over time, but it doesn't do a always have 6 months of reserves before I buy the next house. That is coming. So stay tuned, or whatever the saying is. Stand by. Okay. So that's what I got there. I just want to check on something while I'm doing this. All right. I just noticed I had a little thing. I'll have to rerun these. I'll rerun them in the background here. Rerun all scenarios. Okay, so let's take a look at where he is at. Let's go look at charts. It's going to rerun them. I'll do this chart while I'm waiting for that. Okay. So how long does it take him to buy properties? I think that's sort of like the first thing to look at. Turns out, with only $25,000 saved up and only saving $1,000 a month, he can't even buy his first property until month 54. Month 54. That's like 4 years and 6 months. My math is correct. So he starts off with 25K, and he's in a market where it takes him 54 months to even save up and buy his first property. But by the time he does that, he owns this other property now. The next one he's able to buy at month 110. Then the next one at month 150 something. And so you can see over time, it gets faster and faster for him to acquire these properties. In fact, I'll show this another way. Let's do the summary. Because the summary is going to show us just a list of charts here in the bottom. A list of properties. So he bought one in 5.5 years, 10.08 years, 13.58 years, 16.42, 18.75, 20.75, 22.5, 24, 25.33, and 26. So it took him literally 26 years to buy his 10th property, saving like this. What? That's crazy talk. Yeah, and this is part of the challenge, right? It's like if he's only saving $1,000 a month and the properties aren't cash flowing like crazy, it takes a while in order to save up for these properties. All right. So how long does it take him to achieve his goal of achieving financial independence? It turns out it takes him 29 years and 4 months. It takes him almost 30 years, 29 years and 4 months for him to get to the point where saving up money to buy 20% down rentals can generate enough cash flow, and any money he has invested in the stock market at 4% safe withdrawal rate. Those combined will take him 29 years and 4 months to get to the point where he's able to retire. Okay? That's him doing 20% down. All right. And he does have a lot of money in his bank account. How much money does he have in his bank? Let's see. Bank account balance, total account balance. There we go. So his total account balance, you can see early on, he's got a little bit of money saved up. He keeps saving, buys a property, saving, buy a property, saving, buy a property, saving, buy a property, does that a whole bunch. And then eventually he gets to the point where he stops buying properties and he's just saving his money. We can zoom out and see. And he just keeps accumulating over time. And eventually he has a ton of money. 60 years in, he's got $19.8 million. If we adjust for inflation back in today's dollars, that's like him having $6 million today. So good plan, just takes forever to implement. It's like slow and steady. So what happens though if he decides to do this 25% down property? Let's take a look. Because with the 25% down property, why don't I do it this way? It makes it a little easier for me. I'm going to look at how many properties. First, before I do that, let's do this. I'm going to show you the difference in interest rate and cash flow. So the cash flow was a little bit less than $100 a month for the 20% down. And if you remember the interest rate, it was 3.625. So the 25% down property, and I won't go through all the details. They're all the same, except he's putting 25% down. And now the interest rate, instead of being 3.625, because you put 5% more down, the lenders like those loans better, and they give you a better interest rate. So instead of getting 3.625, now you got 3.25. So you'd expect cash flow to be better when you put 25% down because, number one, you're borrowing less money, right? You instead of putting 20% down, you put 25% down. So the amount of money you have out in a loan is lower, and your interest rate now is lower because when you put 25% down, they give you a preference for that. They give you a preferred rate. So the cash flow on that one is about $248.31 per month. So like this is sort of like the crux of the question in some ways. And I see your question, Lee. I'll get to it in a second. So the crux of the question is it better for Peter to put less down, get a higher interest rate, but maybe be able to buy the properties, at least the first one, a little bit sooner, but he's not going to have as good of a savings rate when he goes to buy the second one, because he's only making $100 in cash flow approximately on the first one if he has 20% down. Or if he does the 25% down one, he makes $150 more in cash flow. He's going to save up faster to be able to buy the next one faster. So does he end up buying properties faster with 25% down or 20% down? This is what we're going to ask ourselves. So Lee says, when speaking of investing the reserve money, what is the best investment vehicle to get a decent return while still having the reserves fairly liquid? If you go watch last week's class, I cover this in excruciating detail. And there's probably more I can cover, but you will have your answer if you go watch the 2-hour class from last week. It's on the podcast, and there's a video on the website, or you can go watch you listen to the podcast. All right, so that's the question. How quickly will we buy these properties? So we'll go back to number of properties owned and when we bought them. And this shows you the chart of the one with the 20% down. Let's go ahead and add in the 25% down ones. Whoa, this is interesting. So the 25% down one is the orange. And you can see that it's still slower for you to save up and do the 25% down. Basically, it takes you, well, I'll zoom in so you can see the difference here. This is the one where we bought the 20%, 54 months versus 67 months. So it took you another 13 months, another year saving up to buy the 25% down properties. So you can see that it takes you longer to buy the properties all the way up to the end. So it doesn't make a big enough difference for you to do the 25% down for acquiring the properties faster. But the cash flow is better. Maybe the cash flow is so much better for Peter that he'll be able to retire earlier because of the 25% down. What do you think? Is that worth checking out? I think so. Let's go find out what the difference in cash flow is. So I could do this a couple ways. I could look at the goal, but first I'm going to look at just total true cash flow, which is cash flow including the cash flow from depreciation. And so you can see the difference. I'm actually going to turn on the lines instead of making them colored in. So these are the lines. So you can see that cash flow is better on the yellow one, which is his 25% down, and it's growing faster as he acquires more and more properties. And you can see once he gets to a certain point here, I don't know, whatever this is, 300 months or so, his cash flow is going to be significantly better for this and just continue to be better over time. Now, you can see there are periods of time here, like right here, where the cash flows are almost the same. And what's happened is because he bought this one property sooner, he actually pays it off. So the property gets paid off because he bought it earlier. So his cash flow improves on those 25. So there's lots of things that are like competing. Because you bought a property earlier, you pay it off earlier, but with the 25% down, you get better cash flow. All these things are just competing for which one takes preference, which one is the most powerful thing for us to do this. And so the cash flows are different enough, but it's not like huge number difference. It's not like, one of them is taken off. Like right here, the difference is $10,190 versus $11,820. So it's like $1,600 more approximately, somewhere in that ballpark. So which one gets him to his goal faster? Let's just jump to the chase. Boom. Very similar. With 25% down, he is able to retire at 28 years and 9 months. When he puts 20% down, he's able to retire in 29 years and 4 months. So what is that? That's about a year. What is that? 7 months faster. 7 months? Is that big of a difference? Not really. And I bet if we ran some of these things with some random variables like rent appreciation or home price appreciation or stock market, like the return from getting your stock market, and those were variable, I could totally see one winning and the other one winning, or the other one winning and the other one winning. I could see them swapping back and forth depending on just how the market performed. I don't think this is statistically significant. I don't think it's like going to make a huge difference for them either way. Okay? Let's now look at, though, the 5% down. I'm going to pull up the property first just so you can see it. And I want to check one more thing, make sure I didn't do something wrong. And if I did, I'll correct it and we'll rerun it. I sure did. So because he put less than 20% down, I didn't have PMI in here. So I'm going to rerun the scenario. And it'll do the corrections. All right, so while it's rerunning, I'll now pull up the property. We can go from there. Okay, so properties. Here it is. So in this case, he puts only 5% down right here. And because he put 5% down and he's owner occupying the property, he's moving into the property, he's going to live there for a year. Then he's going to convert that property after a year to a rental, buy another one, move in, live there for a year. And he's going to keep the properties as he moves out and convert them to rental properties. But the great thing about this is now instead of having to save up 20% or 25%, he only needs to save up 5% down. And because he's moving into the properties and living there as an owner occupant, his interest rate is owner occupant interest rates, not investor interest rates. So what is the difference as of Saturday? The difference between the interest rate for an owner occupant putting 5% down and an interest rate for someone putting 20% down. Well, the 20% down was 3.625. But the interest rate for an owner occupant putting 5% down is 2.625. So a full 1 point lower, significantly lower. Okay. Let's see something here. I think someone says, Cece says, by the way, out of curiosity, could PMI be reintegrated after being taken out if housing prices drop? Random thoughts. Not sure I understand what you're saying there, Cece. Could PMI be reintegrated? Not sure. But I had to fix something. I had to have PMI get removed after 80%. So I'm going to rerun this again. Because I can. That's why. If you want to clarify what you're thinking, I'm not sure I follow what you're saying there. Okay. So with this thing, like what's the cash flow? If you're only putting 5% down, you're not putting full 20% down. You only put a very small amount down. You might think, hey, I probably have negative cash flow, but the interest rate's so much lower. Maybe I don't have negative cash flow if I could rent it year one, which you can't, right? You have to live there for the year. So what does cash flow look like on this? Negative $194 a month. Wait a minute, James, this doesn't make any sense. You're saying I'm going to go buy a property that has a negative $194 a month in cash flow. Why would I go do that? It seems stupid. James, why would Peter be so stupid to go buy a property that has negative $200 a month cash flow? That seems dumb. Doesn't he want to be able to retire? Doesn't he want to be able to use this income from the property in order to be able to retire? How do you retire on negative $200 a month? You're feeding the property. Doesn't make any sense. You're silly. Well, maybe, right? You got to figure. Peter was actually having to save up $80,000 to put 20% down on a property. When he buys the property this way, he only needs to come up with, what's 5% is 400,000? Is it 20K? I think it's 20K. He only needs to come up with $20,000 to do it when he puts 5% down. So imagine for a minute, he could sort of like set aside $60,000 to pay for this negative $200 a month cash flow. So let's do my calculator here. I got my little phone, put my phone up here, calculator, just do a little quick math here. So he's got $194 a month negative times 12. So that's $2,328 negative per year. This is assuming rents don't go up, right? Because rents are going up at 2%, but just play along with me for a minute here. If we have negative $194 a month and rents never go up, which they are in our modeling. So now we've got $23.28 per year negative. If we take that and we divide it by the $60,000 we have by 23.28, I think is what I said. It takes 25 years of paying that negative cash flow to get to the same amount invested in that he had to invest to have 20% down originally. So in other words, he could either buy this property and finance his down payment at negative $200 a month for 25 years in order to get to the same time that he put $80,000 into this property originally to do that. What's going to happen over 25 years? What do you think? Just guess. I think probably property values are going up over a 25-year period. They may not go up in the short term. I don't know. But give me a long enough time, 25 years, I think the chances of property values having gone up is really high. Now, what happens to your loan balance over 25 years? You paid down that loan quite a bit. You also got tax benefits for 27 and a half years from depreciation. So you have all these other benefits kind of coming into play. The cash flow is only one of those four quadrants. So we looked at this thing here. We have negative, I didn't even have to do my calculator. I already anticipated this. 23.28 is the negative cash flow for the year from this. But you had $8,000 in appreciation. You had about $8,441 from debt pay down and about $1,855 in cash flow from tax benefits. And here's an interesting thing, as you probably learned in the class I did on Wednesday night, or other class I've done where I showed the cash flow, the return on investment quadrant here. But if you add these two up, the sum of these is your return from cash flow, like your money now, cash now stuff. So really, it's not negative 23, 28. It's the difference between these, or about, I don't know, squint really hard, negative $500 a year. That's like negative $40 a month. That's the real difference that he's paying in there. So instead of saving $1,000 a month, now he's saving like $950. But he only needs to get to 5% to buy the next property. It's crazy. So maybe buying these properties earlier and letting rents sort of creep up, because we lock in the principal and interest part of that payment when we buy it, but the rents sort of creep up because when you make your mortgage, when you get a loan on a property, you fix in the mortgage payment, right? Your principal and interest part of your payment doesn't change. Taxes will change as property values go up. Your insurance will change as property values go up and get more expensive to insure. But the principal and interest part of your payment remains static. And that's a big chunk of that payment as a percentage. So you have a big chunk that remains unmoved, that stays there. And then rents are creeping up over time. You know, we said 2% a year. So rents eventually are going to make this negative cash flow be positive, or at least be break even. And it doesn't take very long when you include the tax benefits from depreciation adding to the cash flow to be at the point where it's at least holding its own, including tax benefits. Doesn't take long at all. And then he's now got these properties faster. How much faster? Let's take a look. Let us take a look at that. So I'm going to go and do charts. Compare all these charts. All right, don't look. I'm hiding my screen with my hand. You guys can't see it. Let's see here. Number of property zones. Let's take a look at this. I'm going to move off my screen here for a second. So GN says, is there a formula built in to account for increases in taxes and insurance as a property appreciates? The answer is yes. Of course there is, GN. I mean, did you expect anything less than for me to take into account property taxes going up and insurance on the property going up? Didn't you think I would take into account that? It seems reasonable that I would do that, right? Of course I did. Of course I did. Yeah, we basically set the property taxes to be equal to a percentage of the then current value of the property. So property tax, and of course I have a chart for that, because of course I have a chart for that. Let's look at the 20%, that one. I'll just show you because I think it's amazing. All right. So we'll go look at the individual owned properties because I can, and we'll look at property taxes. So property taxes, I'll just turn off all of them. So the property tax on one property, they started out to be about $3,060 per year, and they increase over time on that. If we adjust for inflation, you could see that, you know, what the inflation adjusted number is. It looks like in inflation adjusted dollars, they're about the same. Okay. So yes, I totally take into account that. And you could, if you said, Gian, if you said to me, you know, James, I suspect that we're going to see a increase in the rate of taxes or the rate of insurance. Like the amount that they charge us is not just increasing with inflation, but the amount that they charge us as a percentage of the property value is going up over time. We totally could do that too. We could say, hey, let's set the tax rate to be this amount for the first year or two or three or whatever it is, and then let's increase it to this amount in year 5 or whatever it is, and let's have it go that through 10, and then let's have it be another rate over, you know, year 10 to 20 or whatever you want to do there. You could actually do all that because we could see the property taxes rate here, and this shows you the rate of taxes, which is about 0.7% of the property value. And we do the same thing with insurance. So insurance here is what's the alphabet? H-I-G, H-I-J-K. Where is I? Insurance. Maybe it's property insurance. There you go, property insurance. Same idea here. So here's the property insurance. Oh, what's that? Oh, it's just doing insurance, yeah. So there's property insurance. That's the rates, and this is the one in dollars. So same idea for those, and they are based on the value of the property. My thinking is, you know, it costs more to replace stuff on a property, so the property insurance is going to stay there. If we do raw dollars, that was inflation adjusted. You can see they're going up over time. Okay, tangent done. Check that one off. Here we go now. What was I going to show? Oh, I was going to show you the reveal, and I got distracted. All right, here we go. Here's the reveal. That is craziness. This is total insanity. What's going on here? Okay, so this is like how fast we're buying properties. I'll like reveal it slowly over time. This is the original one where we were saving up 20% down to use buying properties. Okay, that's the speed at which we got to 10 properties. This is time, and you can see that over time we're acquiring properties a little bit faster. It took us this long, 308 months to get to 10. If we say we're saving 25% down properties, it took us a little longer to save up for the 25% down to do that. If we do the 5% down properties, bam, that is way, 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 way faster. Like crazy, crazy fast. He's able to get to the point where he's buying his first property after only, what is this here? I'll zoom in because I can. 8 months. So it only took him 8 months to get to the point where he has enough for down payment, 5% down, to buy a property to move into. Then his personal expenses decreased by that rent he was paying, about the $2,200 a month, because that's the same property he's living in. And then he's able to acquire the properties, live in there. He has to pay the expenses on it while he's living there. But when he converts it to a rental, then he starts to collect rent on it. And he continues to buy the next property and do that. So in this one, he's able to get 10 properties in only 149 months. 149 months. If he could do it as fast as possible, if he was able to save up enough or he had enough money to start with, it would only have taken him 120 months to do it. But in this case, it took him a little while to save up money to buy the first one and a little bit to buy the second one and so on. But they got faster. They were only 12 months apart at the end. So he was able to acquire these properties really quick. So here's the question for you. The interest rate's lower because he bought the property, but we had negative cash flow to start with. How does cash flow look comparing all these? And what about specifically cash flow, including the tax benefits? All right, let's hide some of these so we can see. This is the cash flow we originally had for buying the, I'm just going to look at the first 10 years. Make it a little easier. Oops. All right, so here's the one on 20% down. When he buys a property, the first month he buys the property, you basically don't have to make your mortgage payment because mortgage payments are paid in arrears. So he has like a free month where he gets a lot of cash flow on it, where he didn't have to make that mortgage payment. At the end, they collect it back, but because it's paid 1 month delayed, cash flow looks really good the first month he buys it. So basically, right here is the cash flow at steady state, like $370 a month on the properties that when he's doing 20% down. When he does the 25% down, cash flow is a little bit better, but it takes longer to get that property. And so you can see that with the 5% down Nomad, he has a property and he's not able to collect cash flow until the second property he bought. Because the first one he's living in, so he doesn't get any rent on that. So after the second one, though, it's slightly positive by the time he's ready to rent it, including the tax benefits. That's cash flow from depreciation. So both of those here, he's like $122 a month positive. But you can see, like by the time he gets to month 88 or so, his cash flow, his overall cash flow from all the properties renting out is actually better because he was able to acquire them so much earlier. So his cash flow, even though he had negative cash flow to begin with, is better than when he saved up and put the 20% down or the 25% down and had positive cash flow. Bam! Like my mind is blown. That's craziness. Craziness. Lee says, took him 8 months for the first property, but he needs to live in each one a minimum of 12 months to have the owner-occupied interest rate correct. Yeah, it took him more than 8 months to buy the first property because it took him 8 months to buy the first property, but that's because he was renting somewhere else, and it took him 8 months to buy it. So he doesn't have to wait a year when he's renting. He only needs to wait a year once he buys the property and moves in and lives there. So after the 8 months, then he can't buy his next property until at least month 20. So yeah, you're right. But the first one, he didn't buy a property. He wasn't an owner at that point. He was a renter. So yeah, good question though. All right, so you can see this cash flow. I'm going to zoom out some more. We'll do month 240. This is basically there. So what do you think is going to happen when we see the Nomad cash flow on this thing is so much better? Do you think we're going to be able to retire earlier or later? Let's find out for Peter. Peter, buddy, what is going on, dude? Let's check it out. We're going to compare these all on one chart because we can. The goal, moment of truth, because it's getting to be that time. Oh my goodness. Oh my goodness. Look at this. So these are the two, the 25 and the 20%. They're very, very similar. But here we go, Peter. You got to retire much earlier. 19 years, 3 months. Now, sure, it sucked moving into those properties. But Do you want to stop working a decade earlier? I don't know. Maybe I do. Is it worth doing that? Maybe Peter decides to do that. Maybe he doesn't decide to do that. It's up to him. Here's another interesting. I'm going to take the max off. This shows you like his overall like standard of living, or what percentage of his goal, his target monthly income retirement, the $5,000 a month that he wants to do, what percentage of that is he able to like have being thrown off? And you can see like right here, he's able to be living on almost 5 times that, or $25,000 a month with Nomad. With the other ones, the 20% and 25%, it's more than 2 times it. Okay, so you can see that his standard of living could increase significantly once he hits his early retirement thing. Joe says, when using Nomad, how do you protect yourself from the certain? The certain. Joe is 100% guaranteed he knows something's happening. Okay, the certain future crash, such as we had in the 80s, 90s, 2000s, when rents decline, babies don't love their mothers, all of the people in the world are sad. I'll just continue. So when rents decline, renters default, not paying any rents, and you have negative cash flows on 5 or so properties. I am so glad you asked that, Joe, because that is exactly what the software models. We go and we can say, hey, I'm going to have a random negative event. Either the stock market goes to half, or the stock market loses a third of its value, or maybe it repeatedly loses a third of its value more than one time, and it happens randomly when we least expect it, like COVID, or rents go down by X percent, or property values go down by X percent, or maybe we enter a period of decline where it's going down at this rate over a long period of time. But whatever crazy end of the world, what do they call those movies, like where the world comes to an end, the waters are rising and the tidal waves taking over New York City? What do they call those like movies? Like the ones where like they're trying to doomsday movies. That's exactly right. So any doomsday scenario, Joe, that you want to run and you want to see how your portfolio performs, that's why we wrote the software. Thank you very much for doing that, because you're right. I think it's inevitable. And if it's not inevitable, we should plan for it like it's going to happen. We should plan for it like maybe property values will go down, maybe rents will go down, maybe I won't get 8% in the stock market, maybe I'll lose my job, maybe, who knows what's going to happen, right? But that's why the software is amazing, because we can go in and say, is it better for me to buy properties like this? Or is it better for me to buy properties like this? Or is it better for me to buy properties like this? Is it better for me to have 64 months of reserves and go really, really slow? Or is it better for me to have 3 months of reserves and to go really fast? And part of it is you have to model all of the doomsday scenarios to say, this could happen. If this happens, I'm screwed. Or you could have to say, if doomsday doesn't happen, this looks amazing. And what's the chance of this particular doomsday scenario happening? I don't know. Let's say it's 1 time out of 100. Am I willing to take that risk? Or am I going to kind of put my head in my shell, invest my money in, CDs or, savings accounts in the bank and get 1% and lose ground to inflation? And, you won't be impacted by rents going down, except everyone around you will be. And that could all happen. So I don't know. You got to do all this modeling, but that's where we're going. That's why I wrote the software, because I wanted to see how resilient my portfolio was, right? I'm ready to retire. I'm ready to retire in that I could retire, but I'm not so sure I'm going to retire. But I want to know, hey, is this going to be the end of the world for me? Like, what happens if we see another 2008, 2009? What happens if we see the stock market go down by half? What happens? Like, we saw it go down by about a third for COVID, since recovered. I don't know. So you got to do that. All right. I don't know how I got off on that tangent, but yes. How do you do that? That's what we're going to cover. Not today, because it's already past my time. GN says, is the 5% down using FHA or conventional? 5% down is a conventional loan. You could do FHA. So GN, in the financing class, we talk a little bit about this and the priority order we recommend for doing Nomad. But the really short answer is this. You could go in, and if you found a duplex or triplex or a fourplex for buying a property, your first one, and you were able to find one that made sense, you could do an FHA loan with 3.5% down, buy that property. But then after that, unless you're VA, there's some exception stuff in there. VA, you can do 0% down, even on duplex, triplex, or fourplex. But most of the time, we're going to do 5% down, conventional financing after that. Excuse me, that's the one that tends to work best with the Nomad one. All right, so that is all I have for you today. If you want to drill into any of these crazy scenarios and see like what happens to this and what happens to that and what happens to this and what happens to that, it's all available. So if you like on the blog post, which you guys probably have gotten emails about already, you can copy these to your account if you have a plus or premium account. It may even be with some of them you can do with the free account. I'm not sure. I don't like figure out where the dividing line is. I just do whatever the rule needs to be in order to have happen. But then you can go look at the summary once you copy it into your account, and you can see a quick summary of it all. Or the blueprint is like the ridiculously detailed version of everything that happens. So like if you want to find out what your situation looks like when you're about to buy the property and when you buy a property, so like you could go see like all the stuff and all the math and charts and like narration of what's happening and why it happens and all that stuff. And you can drill down. You can see what it looks like when you achieve financial independence and like what the numbers look like for each of your properties and all that other stuff like that. And so it like the computer generates a narrated version of this for you to dig in and be able to like look at some things that I think are important based on computer software. And so you can do that. And I'm working on improving those more. But Plus members get access to the blueprints of any scenario that we've kind of like included on these. Or you can copy it to your account and see your own blueprints when you're doing that with the Plus or Premium accounts. All right. With that being said, that's all I got for you. Do you guys like story time? You guys like Peter? Peter from Denver. Any final questions before I end for the morning? You are very welcome. You guys are all very welcome. Story time's great. Everyone loves story time. Good stuff. All right, then. I am going to leave unless anyone has any last second questions. You guys are very welcome. I will talk to you all soon. Oh, wait. One last question. Love it. What website do I go to learn more about your offering software? I would just go to the realestatefinancialplanner.com, so the website, realestatefinancialplanner.com. And there's a start here button that kind of goes through a lot of the free classes. And you download the spreadsheet and get a copy of the book I wrote for my son. It's free. Checklists, a whole bunch of things on there. And then if you want to actually sign up for the software, you can do that. But I think it's right here, pricing or something like that. It shows you like what's included in different plans. That's all I got. Thank you. Oh, wait. Oh, one more question. Warren says, does 5% down take into account costs for moving your stuff each year? No, but you could, Warren, you could just go in and say, my closing costs instead of being 2% are now 3% or 3.5% or 2.5% or whatever it is. And you could totally model that if you have really high costs for moving your stuff, or you want to just be more realistic with that, whatever that looks like for you. I know I have a lot of clients that they do it on the cheap. I mean, they are like moving their own stuff or getting a friend to help them, or they got family in town. And so their cost to do it is like nil. But if you want to model that, feel free. I mean, put it in there. I mean, anything you want to model, done. it's already there. It's already there. It's all good stuff. All right. That's all I got then. Thank you, everybody, for coming. I'll see you all tomorrow night. Tomorrow night is the Ask Me Anything, or Ask Me Almost Anything class with Brian. Brian's going to do some amazing stuff. I love these classes where I don't have to do anything. It's so awesome. So, all right, guys. Thanks, everybody. Have a great day. I'm going to stop the recording now. Bye for now.